The offices are quiet. Glass towers stand against November sky. Inside those towers, men in shirts without jackets sit at desks, watching screens that display numbers in red. Outside, the financial district of Manhattan moves with a rhythm that has suddenly become unfamiliar. It is mid-September 2008, and what follows over the next few days will reshape the institutional landscape of American finance in ways that few observers anticipated. This is the story of how Wall Street did not disappear. Chapter 1. The Machine and Its Logic. The financial system that dominated the first decade of the 21st century was not built in a single year or even a single decade. It evolved through a process of deregulation, technological innovation, and a fundamental shift in how Wall Street understood its own purpose. To understand what happened when the system fractured, one must first understand how it was assembled and what assumptions held it together. The roots of modern Wall Street extend back to the aftermath of the Great Depression. In 1933, Congress passed the Glass-Steagall Act, which created a clear separation between commercial banking and investment banking. Commercial banks accepted deposits from ordinary people and businesses, made loans, and held those loans on their balance sheets. Investment banks, by contrast, were focused on raising capital for corporations, trading securities, and serving as intermediaries in the financial markets. This separation was designed to prevent the kind of speculative excess that had contributed to the 1929 crash. For 4 decades, this system held. Commercial banks were regulated, their lending practices constrained, their activities relatively predictable. Investment banks operated with more freedom, but they were smaller institutions, and their failures had limited systemic consequences. The Glass-Steagall framework created stability not through brilliance, but through simplicity. Each type of institution had a clear role, clear constraints, and clear incentives. The system was slow, but it was stable. This equilibrium began to shift in the 1970 seconds and 1980 seconds. Inflation, foreign competition, and technological change created pressure on the old model. Interest rates rose to levels that made the constraints of the old banking system feel increasingly burdensome. Money market funds emerged as competitors to traditional savings accounts. Foreign banks entered American markets with fewer restrictions. Large corporations began borrowing directly from investors through commercial paper markets rather than borrowing from banks. Commercial banks, facing margin pressure and competitive threats, began to lobby for regulatory relief. In 1999, Congress formally repealed Glass-Steagall through the Gramm-Leach-Bliley Act. This legislation, supported by both political parties and signed by President Clinton, permitted commercial banks and investment banks to merge and operate under single holding companies. What had been prohibited for 66 years became legal. The barrier that had seemed fundamental to financial stability simply dissolved. The removal of this restriction did not immediately cause the financial system to collapse. Instead, it accelerated trends that were already underway. Large banking institutions began to combine. Citicorp and Travelers merged in 1998, anticipating the legal change. Bank of America acquired Merrill Lynch in 2008, after the system had already begun to fracture. These mergers created institutions of enormous scale, combining commercial banking operations with investment banking operations under single corporate structures. Alongside this consolidation came a transformation in the nature of investment banking itself. For most of the 20th century, investment banks earned money through 3 primary channels: advisory fees for helping companies raise capital or navigate mergers, commissions from trading securities on behalf of clients, and returns from their proprietary trading operations, where the bank invested its own capital. In the 1990s and 2000s, proprietary trading became increasingly dominant. The transformation was enabled by technology and by financial innovation. Electronic communication networks allowed for faster trading. Derivatives markets expanded dramatically. Securities could now be created, traded, hedged, and packaged in combinations that would have been impossible just decades earlier. The mathematical models underlying these instruments grew more sophisticated. The ability to process vast quantities of data, to model risk, and to execute trades at high speed created new opportunities for profit. The most significant of these innovations involved the mortgage market. For most of American history, the mortgage process was straightforward. A person would approach a bank, provide documentation of income, have the property appraised, and the bank would lend money secured by the property. The bank would hold the mortgage on its balance sheet, receiving monthly payments over 15 or 30 years. The bank's incentive was to lend carefully because the bank bore the risk if the borrower defaulted. In the 1980 seconds and 1990 seconds, this model began to change. Banks started to sell their mortgages to other institutions. Mortgage brokers emerged as intermediaries between borrowers and lenders. The mortgage market began to develop a secondary market structure. Similar to the bond market, mortgages could be bundled together and sold to investors. Mortgage-backed securities were created, representing claims on the cash flows from pools of mortgages. This securitization process initially seemed to have clear benefits. Banks could make a loan, sell it, and immediately recover their capital, which they could then lend again. The originating bank could reduce its credit risk. Capital markets could channel savings into mortgages more efficiently. From a theoretical perspective, the innovation made sense. But securitization created a fundamental problem with incentives. The bank that originated the mortgage no longer bore the consequences of default. Its incentive became not to lend carefully, but to lend quickly and in volume. Each mortgage that was sold immediately became someone else's problem. The originating bank earned a fee regardless of the ultimate performance of the loan. This misalignment of incentives was obscured by the complexity of the securities that resulted from securitization. Mortgage-backed securities were assembled from hundreds or thousands of individual mortgages. These securities were then divided into tranches, with different priority levels for repayment. The safest tranches, those receiving payment first, were assigned AAA ratings by rating agencies. The riskiest tranches were assigned lower ratings. Investors could choose the risk level they preferred. The rating agencies themselves became a critical but problematic part of this system. Moody's, Standard & Poor's, and Fitch held the authority to assign ratings to these complex securities. Their ratings determined which investors were willing to buy them. A security with an AAA rating from one of these agencies was treated by regulators, by pension funds, by insurance companies, and by international investors as nearly risk-free, equivalent to treasury bonds issued by the United States government. But the rating agencies had their own incentive problem. They were paid by the banks that created and sold the securities. If an agency assigned a lower rating than competitors, the bank would simply use a different agency. The agencies competed for business by being generous with their ratings. Internal communications later revealed that analysts at rating agencies understood that many mortgages underlying these securities were of poor quality, yet the agencies continued to assign high ratings. Beyond mortgage-backed securities, financial institutions began to create increasingly complex derivatives. Credit default swaps emerged as a way to hedge against or speculate on mortgage bonds. Collateralized debt obligations, or CDOs, were created by bundling together tranches from multiple mortgage-backed securities. These CDOs were then themselves sliced into tranches and sold to investors. Some of these CDOs were constructed from the riskiest tranches of mortgage-backed securities, yet through the bundling process and the application of mathematical models, the top tranches of the CDO were rated AAA. This process of securitization and repackaging created a fundamental opacity in the financial system. A bank making a loan no longer knew the ultimate purchaser of that loan. An investor buying a security no longer knew the specific underlying mortgages. The connection between the person borrowing money and the person ultimately bearing the risk became attenuated and obscured. Risk was distributed throughout the system in ways that were difficult to measure or track. Chapter 2. expansion, and the illusion of equilibrium. The early 2000s represented a period of expansion and rising confidence in the American financial system. The technology bubble that had burst in 2000 and 2001 had been absorbed without causing systemic financial failure. Interest rates were low. The Federal Reserve, under the leadership of Alan Greenspan, had intervened to provide liquidity following the terrorist attacks of September 2001. The economy recovered. Stock prices rose. Consumer confidence was strong. Housing was at the center of American economic growth during this period. Home prices had historically been stable relative to incomes, rising gradually over long periods. But beginning in the early 2000s, home prices began to accelerate. In 1997, the median home price in the United States was approximately $185,000. By 2006, it had risen to approximately $420,000. This represented a doubling of prices in real terms over less than a decade. The rising prices were driven by multiple factors. Low interest rates made monthly payments affordable, even as prices climbed. Subprime mortgages, loans made to borrowers with poor credit histories or limited income documentation, became increasingly common. In 2003, subprime mortgages represented approximately 8% of new mortgage originations. By 2006, they represented approximately 20%. Some estimates placed subprime lending even higher when including near-prime or Alt-A mortgages, which occupied a middle ground between prime and subprime. Many of these mortgages were adjustable-rate mortgages, or ARMs. The initial rate, typically 2 to 3%, was set low. After a period of 2 or 3 years, the rate would adjust upward, often to 6, 7, or 8%. The payment would increase dramatically. The assumption underlying these loans was that borrowers would refinance when the rate reset, either into a new fixed-rate mortgage or into another adjustable-rate mortgage with a new low initial rate. This assumption depended on home prices continuing to rise, or at minimum, remaining stable. The mortgages were made with little documentation. Stated income loans allowed borrowers to claim income without verification. No money down mortgages became common. Some mortgages had negative amortization, meaning the monthly payment did not even cover the interest being accrued. Brokers were compensated more highly for subprime and adjustable-rate mortgages than for prime fixed-rate mortgages. The financial incentive was clear: originate as many loans as possible, especially in the higher margin categories. These mortgages were rapidly securitized. The banks that originated them sold them within days or weeks. Fannie Mae and Freddie Mac, the government-sponsored enterprises that played a central role in the mortgage market, purchased many of these securities. Large banks purchased them as investments. International banks and investors, attracted by the high yields and AAA ratings, purchased them. The securities were often financed through the sale of commercial paper or through repurchase agreements, where banks would borrow against the securities on a short-term basis, often overnight. The housing boom created a feedback loop. As home prices rose, people perceived their homes as investments that would continue to rise in value. Borrowers who could not afford to purchase homes were encouraged to do so, with the expectation that rising prices would create equity and make refinancing possible. Builders responded to the demand by constructing houses in unprecedented numbers. In 2005, approximately 2.2 million housing units were constructed in the United States, the highest level in history. This represented houses built, but also the associated debt, the materials purchased, the labor employed, all of which was dependent on the continuation of the housing boom. Wall Street institutions participated in this process with enthusiasm and confidence. The largest investment banks had substantial divisions dedicated to mortgage securitization. Investment banks, commercial banks, and specialized mortgage companies all competed to originate and sell mortgages. The origination process was often fragmented, with mortgages being originated by small companies, sold to larger companies, bundled into securities, and distributed through financial networks that spanned multiple continents. The business generated enormous profits and enormous bonuses. Senior executives at banks received compensation packages worth tens of millions of dollars. Mid-level traders and securitization specialists received bonuses in the hundreds of thousands. The profitability of these operations made the financial services industry the most lucrative sector of the American economy. For a talented person seeking wealth, Wall Street was the destination. The confidence in the system extended to the regulatory authorities. Alan Greenspan, as chairman of the Federal Reserve, had long advocated for light-touch regulation of financial markets. He believed that market participants had appropriate incentives to manage risk, that competition would prevent excessive risk-taking, and that complex financial innovations distributed risk throughout the system in ways that made the system safer. These beliefs were not idiosyncratic to Greenspan. They represented the dominant thinking among economists and policymakers during this period. The rating agencies reinforced this confidence. The credit rating agencies, by assigning AAA ratings to mortgage-backed securities, effectively stated that these instruments were as safe as treasury bonds. The fact that sophisticated investors, pension funds, and banks were purchasing these securities in enormous quantities suggested that they were indeed safe. Why would institutions manage hundreds of billions of dollars in assets purchase something they thought was risky? The academic literature on risk and financial markets provided theoretical support for the expansion. The capital asset pricing model, developed in the 1960 seconds, suggested that diversification could reduce risk to manageable levels. Value at risk, or VAR, a mathematical tool developed in the 1990 seconds and widely adopted by financial institutions, provided a framework for quantifying potential losses. Banks incorporated VAR models into their risk management systems. The models typically calculated the maximum loss that might be incurred under normal market conditions over a 1-day or 10-day time period. If the model suggested that losses would not exceed $100 million, the bank would allocate capital to cover that potential loss and would regard the business as acceptable. But these models had significant limitations. They were calibrated on historical data from periods when financial markets had been relatively stable. They assumed that the past was a guide to the future. They often underestimated the likelihood and magnitude of extreme events. They did not account for the possibility that the relationships between different assets might break down during periods of stress. They did not account for feedback loops, where falling prices might trigger forced selling, causing prices to fall further. The period of expansion continued from the early 2000s through 2006 and 2007. Home prices peaked in 2006. The volume of mortgage originations peaked in 2005 and 2006. The profitability of mortgage securitization was at its height. But within the system, stresses were beginning to accumulate. Chapter 3. Excess and the Accumulation of Risk. The period from 2006 through 2007 was marked by a paradox. Even as housing prices began to flatten and mortgage defaults began to rise, the financial institutions dependent on the housing market continued to expand their operations and increase their leverage. Rather than reducing exposure to mortgage risk, they increased it. Rather than tightening lending standards, they relaxed them further. Rather than building capital reserves, they deployed capital in pursuit of profits, based on the expectation that the boom would continue indefinitely. In 2006, Alt-A mortgages, loans to borrowers with limited documentation or weak credit, represented approximately 13% of mortgage originations. By 2007, they represented approximately 20%. No documentation loans, which required no verification of income or assets, became increasingly common. Stated income loans were often made to borrowers who had not earned the income they stated. The industry developed terms for these mortgages that reflected their nature. Liar loans. The loan-to-value ratios, the percentage of the home price that was financed, increased. In the mid-1990 seconds, a loan-to-value ratio of 80% was standard for a conventional mortgage. By 2006, and 2007, loans with 95, 100, and even 105% loan-to-value ratios were common. A borrower could purchase a home without putting any money down. If home prices fell, the borrower would immediately be underwater, owing more than the home was worth. Interest-only mortgages became prevalent, especially in the subprime and Alt-A segments. The borrower would pay only interest for a period of 5 to 10 years, with no reduction in principal. At the end of the period, the payment would increase substantially to include both interest and principal repayment. These loans depended entirely on the expectation that home prices would continue to rise and that the borrower would be able to refinance into a new interest-only mortgage with a lower payment. The securitization of these mortgages accelerated. Investment banks created products with names like structured investment vehicles, or SIVs, which were special-purpose entities designed to hold mortgages and mortgage-backed securities. These vehicles financed themselves by issuing short-term commercial paper and long-term debt. They borrowed at short-term rates and invested in longer-term mortgage securities, earning the spread between the two rates. They used leverage, borrowing substantial sums relative to the capital invested, in order to amplify the returns. The debt issued by these structures was marketed to conservative investors as safe. Money market funds, which are designed for safety and liquidity, purchased commercial paper issued by SIVs. Pension funds purchased the longer-term debt. The rating agencies assigned AAA ratings to much of this debt. The securities were rated as safe as Treasury bonds, despite the fact that their ultimate value depended on the performance of mortgages that were increasingly being made to borrowers with poor credit and limited documentation. The largest investment banks had substantial exposure to this market. Citigroup had SIV structures holding over $100 billion in assets. Bank of America, Merrill Lynch, Morgan Stanley, and others had similar structures. These were often described as off-balance sheet investments because they were technically held by separate entities and did not appear directly on the bank's balance sheets. But the banks had implicitly guaranteed the debt issued by these structures, which meant that if the structures encountered financial difficulties, the banks would be expected to support them. Beyond the SIVs and the securitization market, investment banks held enormous amounts of mortgage-backed securities on their own balance sheets. These were financed through repurchase agreements, short-term borrowing secured by the mortgage securities. The banks would borrow overnight or over short periods, financing mortgages that had long maturities. They depended on being able to continuously roll over this short-term funding. If the market for repurchase agreements dried up, the banks would be unable to finance their holdings. Leverage within the financial system increased substantially. The ratio of assets to equity, a measure of leverage, rose significantly. By 2007, some investment banks had leverage ratios exceeding 30 to 1. This meant that a decline of merely 3% in the value of their assets would eliminate their equity capital entirely. The larger the leverage, the more sensitive the bank's financial position to changes in the value of its holdings. The mortgage crisis itself, when defaults began to accelerate, was not a surprise to all observers. By 2006 and 2007, a small group of hedge fund managers, mortgage analysts, and academics were expressing concern about the sustainability of the housing boom and the quality of the mortgages being originated. A few investment banks began to shift their positions, becoming less reliant on the mortgage market. But the mainstream view within the financial industry and among policymakers and rating agencies remained confident that the system was sound. The assumption that supported this confidence was that housing prices would not decline significantly on a national basis. The argument was that American housing was geographically diverse, with different markets facing different supply and demand conditions. A regional downturn might occur, but a simultaneous decline in prices across all major housing markets was considered unlikely. Additionally, even if prices declined modestly, the expectation was that borrowers with any equity in their homes would continue to make payments. This assumption proved to be incorrect. Beginning in 2006 and accelerating through 2007 and into 2008, housing prices began to decline. By 2009, home prices had fallen from their peak by approximately 30% on a national basis. In some markets, the declines were even steeper. The decline was unprecedented in scale since the Great Depression. As home prices fell, the mechanism that had supported the expansion ceased to function. Borrowers who had relied on refinancing into a new mortgage as the initial rate reset found that they could not refinance. The home was now worth less than the mortgage balance. Borrowers began to default. Initially, defaults affected primarily subprime borrowers. But as the extent of the decline became apparent, defaults began to spread to Alt-A mortgages and eventually to prime mortgages. The mortgage-backed securities that had been rated AAA began to suffer substantial losses. The models that rating agencies had used to assess the probability of default proved to be catastrophically wrong. The securities that had been treated as safe as treasury bonds were suddenly revealed to contain enormous embedded risk. Chapter 4. Contagion and the crisis deepens. The financial crisis of 2008 was not a discrete event that occurred on a particular day. It was a process that unfolded over months, with different phases and different episodes. Each phase revealed new problems. Each episode created contagion effects that spread through the financial system. The first phase involved the collapse of the mortgage market and the realization that mortgage-backed securities held by banks, investment firms, hedge funds, and pension funds were worth substantially less than had been assumed. The companies most directly exposed to the mortgage market began to fail. New Century Financial, a large subprime mortgage originator, filed for bankruptcy in April 2007. IndyMac Bank, a large mortgage lender, failed in July 2008. The failures of these companies were, in isolation, not sufficient to threaten the broader financial system, but they signaled that the sector was in crisis. The collapse of the mortgage market revealed that the complex securities created through securitization were not as well understood as had been assumed. A mortgage-backed security held by an investor was notionally backed by thousands of individual mortgages, each with specific characteristics. But in practice, investors often did not know the details of those underlying mortgages. The rating agencies had provided an assessment of credit risk, but that assessment proved to be unreliable. The models used to price the securities often did not account for the possibility that home prices might decline simultaneously across the entire country. The second phase involved the crisis of confidence in the securities themselves and in the institutions holding them. As mortgage-backed securities declined in value, the question became, which institutions held substantial quantities of these securities and might therefore face losses? The answer was, many of them. Investment banks held mortgage-backed securities on their balance sheets. They held them in SIVs and other off-balance sheet structures. They had issued derivatives that created exposure to mortgage risk. Commercial banks held them. Insurance companies held them. Pension funds held them. International banks and investors held them. The decline in the value of these securities created losses. The magnitude of the losses began to be estimated in the tens of billions of dollars and eventually hundreds of billions of dollars. More significantly, the losses created uncertainty. If the value of mortgage-backed securities was lower than had been assumed, how much lower might it ultimately be? Which institutions would suffer the largest losses? How much capital might be wiped out? The uncertainty itself became destabilizing. Market participants began to demand higher interest rates or risk premiums to compensate for the uncertainty. The market for repurchase agreements, through which investment banks financed their holdings, began to deteriorate. In March 2008, Bear Stearns, a large investment bank with substantial exposure to mortgage securities, found itself unable to finance its operations. Its counterparties were unwilling to extend credit. The bank's funding evaporated. Faced with the prospect of a total collapse of one of the largest financial institutions in the United States, the Federal Reserve orchestrated a merger with J.P. Morgan Chase arranging for the central bank to provide financing for the transaction. Bear Stearns, which had been a prominent financial institution for over 85 years, effectively ceased to exist as an independent entity. The rescue of Bear Stearns was intended to stabilize the market by demonstrating that major financial institutions would not be allowed to fail. But the rescue also revealed the fragility of the system. If Bear Stearns, despite being a major investment bank with a long history, could face a funding crisis so severe that it required emergency intervention, what other institutions might face similar crises? The question created further uncertainty and further pressure on other investment banks. The third phase, which began in September 2008, involved the simultaneous crisis of multiple large institutions. Lehman Brothers, another major investment bank with substantial mortgage exposure, faced a funding crisis similar to that experienced by Bear Stearns. Unlike Bear Stearns, no merger was arranged. On the 15th of September 2008, Lehman Brothers filed for bankruptcy. The bankruptcy was the largest in American history in terms of assets involved. The failure of Lehman Brothers created panic. The bankruptcy was widely perceived as a failure of the government to manage the crisis appropriately. If Lehman Brothers could fail, the logic suggested, then any institution might fail. In the days following Lehman's bankruptcy, financial institutions became reluctant to lend to one another, even on a short-term basis. The credit market, which is essential to the functioning of a modern financial system, began to seize up. The same day that Lehman Brothers filed for bankruptcy, Merrill Lynch, one of the largest and most prestigious investment banks in the world, was forced to merge with Bank of America. In subsequent days and weeks, Washington Mutual, which had been the largest savings bank in the United States, failed. Wachovia, which had significant mortgage exposure, agreed to be acquired by Wells Fargo. AIG, a major insurance company that had written credit default swaps on mortgage securities, faced a funding crisis and required an emergency rescue from the Federal Reserve. The panic extended beyond the investment banks. Money market funds, which are essential sources of financing for many financial institutions and are regarded by investors as safe, experienced withdrawals as investors sought to move their money into treasury securities or bank accounts. In the week following Lehman's bankruptcy, assets in money market funds declined by over $100 billion. The Federal Reserve was forced to guarantee money market funds in order to stop the outflows. The interbank lending market effectively stopped functioning. Banks were unwilling to lend to one another. The London Interbank Offered Rate, or LIBOR, which is the rate at which banks lend to each other, spiked dramatically. The spread between LIBOR and Treasury rates, which normally is minimal, reached historically high levels. The credit default swap spreads on major banks widened, reflecting market expectations that multiple large banks might default on their obligations. The deterioration of the credit markets was not limited to the United States. International banks had substantial exposure to mortgage-backed securities. European banks had purchased significant quantities of mortgage-backed securities and SIV debt. The crisis spread to Tokyo, to London, to Frankfurt. Banks in multiple countries faced losses and funding pressures. Chapter 5. Intervention and Transformation. The scale and rapidity of the crisis required unprecedented intervention by the government and central banks. In previous financial crises, government intervention had typically been limited to actions by the central bank. The central bank would provide short-term lending to solvent financial institutions facing liquidity problems. This approach was based on the assumption that the underlying problem was a shortage of liquidity rather than a shortage of solvency. If an institution was fundamentally sound but temporarily unable to access credit, central bank lending would allow it to survive until confidence was restored. But the financial crisis of 2008 involved both liquidity and solvency problems. Some institutions were facing a shortage of liquidity and could potentially survive with additional funding. But others had suffered losses that had wiped out a substantial portion of their capital. For these institutions, providing additional liquidity would merely delay the inevitable failure. The intervention required direct government action, not merely central bank actions. Congress passed the Troubled Asset Relief Program, known as TARP, which allocated $700 billion to address the crisis. This represented one of the largest government expenditures in American history. The funds were to be used to purchase troubled assets from financial institutions or to provide direct capital injections to banks. The initial authorization for TARP was controversial. Many observers argued that government should not intervene to rescue financial institutions, that the market should be allowed to work, and that executives and shareholders of failed institutions should bear the consequences. But policymakers, drawing on historical experiences and economic analysis, concluded that the collapse of the financial system would have catastrophic consequences for the broader economy. The argument for intervention rested on the concept of systemic risk. If major financial institutions failed in rapid succession, the argument went, the basic functions of credit provision and capital intermediation would stop working. Businesses would be unable to borrow to finance operations or expansion. Households would be unable to borrow to purchase homes or vehicles. The financial system serves as the circulatory system of a modern economy. Damage to that system would damage the entire economic body. This argument proved persuasive, though not without substantial dissent. Congress authorized the TARP funds. The executive branch, first under President Bush and then under President Obama, began to deploy them. The funds were used to provide direct capital injections to large banks. Citigroup received approximately $45 billion in injections and guarantees. Bank of America received approximately $45 billion. Wells Fargo, J.P. Morgan Chase, and other large banks also received substantial injections. The capital injections prevented the immediate failure of these institutions. They provided capital to absorb losses and continued lending operations. But the provision of capital was controversial. In some cases, the capital was provided in the form of preferred stock, which had characteristics of both debt and equity. The terms of these investments were often favorable to the banks, with dividend rates that seemed generous given the circumstances. Beyond TARP, the Federal Reserve initiated a series of emergency programs designed to stabilize the credit markets. The central bank established lending facilities for primary dealers and money market funds. It began purchasing treasury securities and mortgage-backed securities on a large scale. This program, called quantitative easing, was designed to put money into the financial system and to lower long-term interest rates. The Federal Reserve also dramatically lowered its short-term interest rate target. In September 2008, the federal funds rate, the rate at which banks lend to each other overnight, was approximately 2%. By December 2008, it had been reduced to near zero. The Fed held rates at this level for an extended period, providing financial institutions with access to borrowing at minimal cost. The combination of capital injections through TARP and liquidity provision through Fed programs halted the immediate crisis. The panic that had gripped financial markets in September and October 2008 subsided. Large banks had access to funding. They were able to continue operations. Financial institutions that otherwise would have collapsed were kept intact. The question of what would happen to the assets held by these institutions remained unresolved. The financial institutions had purchased substantial quantities of mortgage-backed securities and other complex securities at prices that now appeared to be far too high. The value of these assets had declined dramatically. In some cases, the decline meant that the securities were worth 50 cents on the dollar or less. These assets sat on the balance sheets of major banks throughout 2008 and 2009. The response to this problem evolved over time. Initially, TARP was supposed to purchase these troubled assets directly, removing them from bank balance sheets. This plan, called the Public-Private Investment Program, was slow to implement. Banks had little incentive to sell assets at market prices if they could avoid it. The government was reluctant to purchase assets at prices higher than market value, which would amount to a hidden subsidy to the banks. Instead, the approach shifted toward allowing banks to slowly work through the problem. Banks held the troubled assets and gradually sold them or allowed them to mature. The accounting rules governing how these assets should be valued were relaxed. In March 2009, the Securities and Exchange Commission, which regulates financial reporting, allowed banks to value some assets at internal pricing models rather than at market prices. This mark-to-model accounting approach allowed banks to report higher asset values and maintain higher reported capital levels than would have been the case if strict market-based pricing had been applied. The relaxation of accounting standards was justified on the grounds that market prices were distorted and did not reflect the true economic value of the assets. But it also allowed banks to defer recognizing losses and to maintain the appearance of financial strength. The approach was controversial, with some observers arguing that it involved manipulation of financial reporting. As the immediate financial crisis subsided, attention shifted to the broader economy. The failure of credit markets had profound effects on the real economy. Unemployment rose rapidly. Foreclosures on homes accelerated. The manufacturing sector contracted sharply. Construction activity declined. Gross domestic product, the total value of goods and services produced, declined in 2009 for the first time since the Great Depression. The government response to the economic crisis was substantial. Congress passed the American Recovery and Reinvestment Act in early 2009, providing approximately $800 billion in stimulus spending and tax reductions. The federal government increased spending, ran large deficits, and borrowed heavily to finance the spending. The federal budget deficit, which had been approximately $450 billion in 2008, reached approximately $1.4 trillion in 2009. Government debt outstanding increased from approximately $10 trillion to over $13 trillion. The combination of government spending and monetary stimulus gradually stabilized the economy. The decline in economic output stopped in mid-2009. The unemployment rate, which had peaked at approximately 10% in late 2009, began to decline. Housing prices stabilized. The financial system, which had seemed on the verge of collapse in late 2008, began to recover. Chapter 6. Survival and Aftermath. By late 2009 and early 2010, it had become clear that the major financial institutions that had faced near-death experiences would survive the crisis. Banks repaid the capital provided by TARP. The government, which had authorized the spending of $700 billion, ultimately deployed approximately $430 billion. Much of the money provided to financial institutions was repaid with interest. When the program concluded, the ultimate cost to taxpayers was substantially lower than had been anticipated, though still representing transfers of tens of billions of dollars. The survival of large financial institutions meant that the structure of Wall Street that had existed before the crisis largely persisted afterward. The institutions that had been the largest before the crisis remained the largest afterward. Citigroup, Bank of America, Wells Fargo, J.P. Morgan Chase, and Goldman Sachs continued to dominate. Some consolidation occurred, with healthier institutions acquiring weaker ones, but the overall structure did not fundamentally change. What did change was the recognition of the systemic importance of large financial institutions. Before the crisis, the view had been that financial markets were self-regulating, that large institutions would manage their own risk, and that government intervention was generally counterproductive. After the crisis, policymakers and the public generally accepted that some financial institutions were too big to fail, meaning that the government would not allow them to fail because the consequences would be catastrophic. This recognition led to regulatory changes. Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. The legislation created a Financial Stability Oversight Board to monitor systemic risk. It imposed stress tests on large banks, requiring them to demonstrate that they could survive a severe economic downturn. It limited the proprietary trading activities of banks, attempting to reduce the conflicts of interest between the bank's own risk-taking and their responsibilities to customers. It created a new Consumer Financial Protection Bureau to oversee mortgage and other consumer lending. The Dodd-Frank Act represented the most significant financial regulation since the Glass-Steagall Act of the 1932. It attempted to address the specific problems that had contributed to the crisis. But the act was also incomplete. Some of its provisions took years to implement. Some provisions were subsequently modified or weakened. The act was shaped not only by the objective of preventing future crises, but also by political compromises and the powerful position of financial institutions in American politics. The question of whether the survivors of the financial crisis had learned from the experience remained unresolved. In the years after the crisis, bankers argued that they had implemented substantial risk management improvements. They had increased capital holdings. They had improved their stress testing procedures. They had reduced reliance on short-term funding in wholesale markets. But critics argued that the underlying structure of the financial system had not fundamentally changed. The incentives to take risks, to pursue high profits, to leverage balance sheets to maximum extent possible, remained intact. In 2009 and 2010, as the crisis subsided, compensation in the financial services industry recovered remarkably. Financial institutions that had been rescued with taxpayer money were paying multi-million-dollar bonuses to executives and traders just months after the crisis had threatened their existence. The bonuses were justified as necessary to retain talented personnel, but they also suggested that the consequences of the crisis had been distributed unequally. The executives and shareholders of financial institutions had largely been protected by government intervention. The employees of failed institutions, the homeowners who had lost their homes to foreclosure, and the workers in the broader economy who had experienced unemployment as the economy contracted had borne greater costs. The recovery of Wall Street paralleled the broader recovery of the financial system and the economy. Stock prices recovered. Financial institution earnings recovered. In 2009, banks returned to profitability. By 2010, financial institution profits exceeded pre-crisis levels. The period of danger had passed. The institutions had survived. The question of how the financial system had come to the brink of collapse and how it had been rescued became a subject of extensive analysis, investigation, and debate. Congress held hearings. Academic researchers studied the events. Government agencies issued reports. Books were published. The dominant narrative that emerged was that the crisis had resulted from a combination of factors: the deregulation of the 1990 seconds that had removed constraints on risk-taking, the emergence of financial innovations that had made risk difficult to measure or understand, the misaligned incentives that had led mortgage originators to make poor loans, and financial institutions to hold or distribute risky securities, the failures of rating agencies and credit risk models, and the irrational exuberance of market participants who had lost sight of fundamental risks. But the question of personal responsibility remained ambiguous. Criminal charges were brought against a relatively small number of individuals, mostly lower-level employees, who had committed outright fraud. No senior executives at the major institutions were convicted of crimes related to the financial crisis. Investigations and lawsuits proceeded, but reached many institutions rather than individuals. The question of whether specific people had made intentional decisions that contributed to the crisis, or whether the problem was rather embedded in the systems and incentives within which people operated, was never definitively resolved. The legal and regulatory response reflected this ambiguity. Some institutions settled government investigations by paying substantial fines, but without admitting wrongdoing. Some executives resigned or were removed from their positions, but many continued in leadership roles. The standard interpretation became that the crisis had resulted from systemic failure rather than individual malfeasance, which meant that punishment of individuals seemed inappropriate, but also that the structural changes needed to prevent future crises remained uncertain. Chapter 7. The question of whether anything truly changed. The period from 2010 forward was marked by recovery and relative stability in financial markets. The stress that had characterized 2008 and 2009 receded. Financial institutions rebuilt their capital. Stock prices recovered and reached new highs. The financial system, which had seemed on the verge of collapse, stabilized and resumed its function of intermediating capital and credit. The regulatory changes that had been implemented, primarily through Dodd-Frank, represented a significant expansion of government oversight. Banks were required to report their financial condition regularly to supervisors. They were required to conduct stress tests. They were required to maintain higher levels of capital relative to their assets. They were prohibited from proprietary trading activities that would directly conflict with their service to customers. New agencies were created to provide consumer protection in financial markets. Yet observers disagreed about whether these changes were sufficient to prevent another crisis. Advocates for stronger regulation argued that the underlying structure remained problematic. The largest financial institutions had become even larger through acquisitions during the crisis. The concentration of financial resources in a handful of institutions meant that the failure of any one of them would likely require government intervention. The incentive problems that had driven excessive risk-taking had not been fully resolved. The complexity of financial instruments had continued to increase, creating new forms of opacity and risk. Advocates for lighter regulation argued that the Dodd-Frank reforms had already substantially constrained financial institutions' ability to take risks. They argued that further regulation would be counterproductive, reducing financial innovation and economic dynamism. They pointed out that the financial system had survived the crisis and returned to normal functioning. They argued that financial institutions had learned from their experiences and would not repeat the same mistakes. The survival of Wall Street itself had become a matter of interpretation. From one perspective, Wall Street had collapsed and had to be rescued by government intervention, which could be seen as a failure of the financial system. From another perspective, the institutions had survived, government intervention had been effective, and the financial system had demonstrated its resilience. The interpretation one chose determined the conclusions one reached about whether the system required fundamental reform. What was clear was that the fundamental structure of the financial system had not been dismantled. The largest banks continued to operate as large, complex institutions combining commercial banking and investment banking operations. The securitization of mortgages and other loans continued, though at more modest levels. Derivatives markets continued to exist and to grow. Financial innovation continued. The profit motive that had driven the pre-crisis expansion continued to drive financial institution behavior. The absence of dramatic regulatory overhaul reflected multiple factors. The political power of financial institutions remained substantial even after the crisis. The complexity of the issues involved made comprehensive reform difficult to design and implement. There was genuine disagreement among experts about what changes were necessary. The recovery of the financial system itself seemed to validate the argument that the crisis had been an aberration rather than a fundamental failure requiring structural change. The decade following the financial crisis saw the continued dominance of Wall Street in the American economy. Financial institution profits remained high. Financial sector compensation remained elevated. The largest financial institutions grew larger through acquisitions. The concentration of wealth in the financial sector and among the highest-paid individuals continued to increase. But the crisis had altered the relationship between Wall Street and the government. The explicit recognition that large financial institutions were too big to fail meant that government stood behind these institutions in a way that had not been previously acknowledged. This implicit guarantee of government support reduced the borrowing costs of large banks relative to smaller institutions, creating a form of subsidy. The knowledge that government would intervene to prevent systemic collapse changed the incentives and risk calculations of financial institutions. The survival of Wall Street institutions, then, was not a survival of the status quo ante. It was a survival that depended on government support, and that was accompanied by expanded government oversight. Whether this represented a stable new equilibrium or a temporary state that would be disrupted by future crises remained an open question. Epilogue. In the years after the financial crisis, the American financial system continued to grow in size and complexity. The restrictions imposed by Dodd-Frank were modified or weakened in subsequent legislative sessions. Economic growth resumed. Stock markets rose to record highs. Financial institution profits expanded. The crisis, which had seemed like it would require fundamental change, came to be regarded as a discrete event that had been overcome. But the fundamental problems that had contributed to the crisis remained embedded in the structure of the financial system. The large size of major financial institutions meant that their failure would still have catastrophic consequences. The opacity of financial instruments meant that risk remained difficult to measure or understand. The incentive structures that rewarded high profits, regardless of the risks involved, remained in place. The assumption that the government would rescue major institutions meant that the normal market discipline on risk-taking had been partially suspended. The survival of Wall Street was therefore a qualified thing. The institution survived. The system continued to function. Government intervention prevented total collapse. But the survival came at a cost to the broader public, which had borne the burden of unemployment, housing foreclosures, and slow economic recovery. The survival also came with the tacit acknowledgement that the financial system was now explicitly supported by government, that the distinction between private financial markets and public government institutions had become blurred. The history of how Wall Street survived the Great Collapse of 2008 is therefore not only a story of financial institutions overcoming a crisis. It is a story about the nature of financial systems and government in modern economies, about the distribution of risk and cost, about the relationship between profits and stability, about the question of whether a financial system designed primarily to maximize returns to investors can be made stable enough to serve the broader economic needs of a society. The events of 2008 demonstrated that the financial system was far more fragile than most observers had assumed. The recovery demonstrated that large financial institutions possessed substantial resilience when supported by government resources. Whether the system had learned from the crisis or whether it remained vulnerable to similar shocks was a question that could not be definitively answered in the period immediately following the events. History would provide the answer, perhaps through another crisis or perhaps through decades of stability, that would suggest that the post-crisis reforms had been sufficient. Until that answer emerged, the history of Wall Street's survival remained incomplete, a story that had reached a middle point, but not a conclusion.